Good afternoon, everybody. Welcome to your Friday edition of the TraderMerlin Show. It is a Quadruple Witching Friday, hence the graphic there. I see that some people are going, what is that? We got witches and all kinds of... Yeah, it's Quadruple Witching, which is the expiration of options, index futures, options on futures. Hell, there's just so many damn witchings going on today. Anyway, I thought it'd be fun to have a little fun of the graphics there and a bunch of witches staring at me angrily. So that's what we're going to talk about today. We'll talk about the triple witch, talk about what happened to the markets, but most of all, cheers to everybody. Congratulations to the Golden State Warriors for a hell of a series and against all odds, coming back from a rough start to win the NBA championship. Just honestly, you're witnessing a living legend there. Steph Curry, first ballot Hall of Famer, one of the greatest shooters to ever play the game, and Klay Thompson, who for all intents and purposes was done with basketball, ruptured Achilles, 2 years of rehab, comes back and wins an NBA championship. So shows you that perseverance, hard work, you can accomplish anything that you want to do. So cheers to all of you as well. Hope you had a great trading week out there. I'm going to have a sip of this Bib and Tucker and get the show started. Oh, that's so good. It's going to be a good weekend. I can already tell. All right. It is, as you can see, the correct date here today. I had the wrong one up yesterday. It's the 17th of June. Of course, as you guys know, we're going to have Monday. The markets will be closed for Juneteenth, and then we back on for our Tuesday session. So I'm going to take a 3-day weekend as well, taking lots of days off from this show. All right, let's start things off by looking at the overall market. I'm going to start by looking at economic data. There's a few things that I think are rather noteworthy for today. I want to make sure we get through those, and then a lot of charts. We can talk about some of the other macroeconomic pieces that might be coming our way. But we'll start things off with this economic calendar here. Now, the reason I bring this up is I'm glued to economic data to see any sort of little sign of change happening. And if you notice on the economic calendar here, I'm really focusing on the US dollar near the bottom. So you had capacity utilization rate, which was 78.9. Make sure I got this right. Yes, this is... For some reason, the data looked weird to me. Sometimes I question myself, like, did I get the right data on this one? But yeah, we got the right data here for the 17th. So, as far as capacity utilization, it actually was a little bit higher than the previous number, but lower than the expectation. So all in all, we could put that as a big negative mark. I'll put an X next to that one. Now, if you look at the next one, this is where it really starts to get shaky. We already saw things like the Philly Fed Manufacturing Index going negative. That was yesterday. The expectation was for industrial production to decline, going from 1.4 down to 0.4, so a decline of 1%. Well, not only did we drop 1%, but we actually increased even further to the downside, coming out at 0.2%. So we'll say that is another big X mark, and an X being negative for the markets overall. Now, 0.2% is still positive, which means there's some gains going on with regards to industrial production, but all in all, if we start to get negative here, then again, that leads to negative GDP, and this cycle that we've been talking about for a few months may potentially get even worse and worse and worse. So a very interesting to see the economic data that came out today. And of course, CB leading index was right in line with expectations. Now, let's go and look at our overall markets, because that was the fun spot today. Let me get my charts up here, especially for those of you who might have been in crude oil. Here is... I'm looking at the 10-year. I'm going to start things off with crude oil ripping down below that 114.50 mark, which I actually thought we'd see it hold, right? We bounced off that on Wednesday, broke through it on Thursday, but kind of what I thought would be kind of a hammer and a continuation of the upside. And lo and behold, you have just a giant red candle that just erases a lot of gains. Now, again, we still are in an uptrend with crude oil, but today's candle, and I think a lot of the pressure from the Biden administration and just the American people getting pissed off because gas is, $6-7 a gallon, putting a little bit of pressure on oil companies. And you saw crude oil with a fairly sharp decline today of 7.6%, making it by far your worst performer. Yes, even worse than Bitcoin. So I'll work my way up here, and then we'll dive into some of these other topics. Bitcoin, really no big story here. Again, I am still bearish. I will say it probably every day we start that I'm still bearish on it. You had a small spinning top today. So we got a small little candle right here, which basically means there wasn't a big range in Bitcoin today. Fairly compressed, open and closed right around the same price. As you can see, it says 0.82% change for Bitcoin on the day. But given all the negative stuff, again, with 3RS Capital and some of these other capital firms, as well as the lending protocols, I still think that there's a lot of skeletons to come creeping out of the woodwork here with regards to bad stuff in crypto. So expect more downside move. And yeah, Randall, I got your question and a bunch of other questions. So for those who might be new, most of the time we get the regulars here. But for those of you who are new, click that subscribe button. The show is live just about every day at 2 p.m. Pacific time. The subscribe button will get you alerted. And if you hit the little bell notification when we go live, it'll automatically tell you on your phone. If you have questions, you can always email me at TraderMerlin@gmail.com or put them down below any YouTube video that you watch if you have a question, and I'll try to answer those first. Today, the questions we'll get to were predominantly ones that were sent in on the YouTube chat. All right. That's right, Frick Joe. It is a Bibb and Tucker 6-year-old bourbon for me. This is such a great whiskey. I still have to go down and get the Frey Ranch from Ron. That was my endeavor for last weekend, which I didn't get to do it, but Ron gave a nice donation for the bottle of Frey whiskey, which looks delicious, and I'll be getting that this weekend, I promise. Yeah, we do have a lot of... It's funny, Randall says kids are all over the place. Seattle, Green Bay, Miami, Las Vegas, Portland. It's not only that. I was just looking at the downloads for the podcast, which, you know, I'm not a huge podcast influencer by any means, nor do I ever aspire to be. I think if people like the show, then good for them. I always appreciate giving out good information, hopefully helping everybody with their trading and investing, at least from a psychology and structure perspective. But I noticed that, like, most of you are in the United States, but boy, there are some people from all over the world. So a shout out to, you know, I guess the global community who is all over the place. I saw Singapore, Australia. I even have some Russians following. So just don't hack my stream, please. But yeah, it's good to have the Russians with us as well. As long as we treat people good, I don't care where you're from. We all have a short time on this planet, so be good to one another, and hopefully we grow together. All right, let me go back to our charts here. Thank you, Lori. That's right. Click that like button. I don't know if clicking the like button helps the review rankings or the ranking search engine rankings, but you know what? It makes me feel good when I see a bunch of likes on the show. So if you like it, click the thumbs up. All right, let's move on. I actually was kind of surprised at this one, even though we saw some decent moves up in the equity markets. Commodities giving back a bit of the ground. You see here, 0.42% decline for gold today. It was a beautiful day yesterday. As you guys know, I am long gold. I will continue to stay long gold for years just because I'm buying gold coins, typically rare gold coins. But today we had a little bit of a gap up and then gave back quite a bit of yesterday's move to the upside. But all in all, we still are kind of floundering sideways here with a slight, ever so slight uptrend on gold futures. Now we move to the major indexes, which stole the show. It was a clean sweep of the top 4 spots for the indexes. Here's your Dow Jones Industrial Average, which doesn't look great. It actually shows a gain of 0.07% as of this exact second. And, you know, to me, this is another indecision moment. I'm really curious to see what happens at the beginning of next week because you had this super aggressive sell-off. I mean, out of the last 7 days, 1, 2, 3, 4 of those are gigantic red candles that finish at the dead lows. I mean, these are really ugly candles here. And then you have the small little green one from Wednesday. Today, spinning top indecision, which going into a weekend, I guess that makes sense, especially a 3-day weekend. I kind of anticipated people selling even more to unwind and just be like, I'm out over the weekend. But an indecision candle usually can be traded, well, at least for me, it can be traded very simply, right? You look at that indecision candle and you say, as long as price stays within that range, I don't care. But as soon as it breaks out of that range for the Dow being 29,637, at the bottom, top of that range is 30,206. If it breaks out of that, either up or down, go long or short, whichever way it moves. So, you know, it's simple things like that that keep you out of forcing trades. But indecision candles like this after a very big sell-off, I am definitely a fan of. I think you'll probably see some big moves early next week when these futures markets open. All right. That was the Dow. S&P, a similar picture, although it was a little bit higher up at 0.34%, so we won't talk much about trading that one. Russell 2000 was up 1.04. It did have a green candle, even though not a huge one. It was up 1.04%. And lastly, the NQs, which also have what's called a spinning top formation, 1.35% move to the upside, closing at 11,307, but still in an aggressive downtrend. So I thought, as I mentioned on Monday, I told you guys I sold puts on the triple Qs. I I was long puts. I bought some puts a couple weeks before, rode that down, closed those puts out for a rather nice profit, and decided to sell some puts, which would basically say I was willing to buy the NASDAQ 100 if it dropped to 269. And for that, I was paid about a 1.2% rate of return for 4 days, as long as price closed above 269. Yesterday looked a little bit shaky. Thought I might actually be put those shares, but we had a little bit of an update today. So the great news for me anyway is those puts that I sold on Monday expired worthless. I got to keep my money, and I will probably do the exact same thing next week if the premiums are there. So, for those that aren't into selling options, I would encourage you to study, learn how to be an options seller. It's not the super flashy, really glamorous, I'm making hundreds of percent rates of return as an options seller, but there is an air of consistency to it. And I was a bit aggressive with that options trade that I did on Monday. Absolutely. Going 4 days out at 269, that's pretty short term, but the reward was so worth it, right? 1.2% for 4 days. I think everybody here would jump at that chance as long as your risk was manageable. So I wanted to share that one. Other pieces out here I think are important was that dollar index, right? We had a big sell-off yesterday, and it just kind of recouped some of that. Still, we have a ways to go to get to the level that I'm targeting, which is that 106.50 mark. I do think we're going to get there. I'm curious as to see what the follow-through from this recent pullback is. You had 2 days of pullback, right just almost into a demand zone. It was ever so close to this demand zone that I have in yellow here from a 4-hour time frame, and then moved up. So I still think we're in a bullish trend on the dollar. And then lastly, before I dive into questions, we'll look at that 10-year, which had a pretty aggressive sell-off the last 2 days, but still maintaining 3.2%, and we're kind of stuck there right now. So going forward, we'll have to wait and see what these bond auctions look like and the impact that it has on this 10-year yield. But I think many of you may have seen this. That 30-year fixed-rate mortgage, 6.3% now. When we were talking about this back in November, and it was under 3%. So you have seen the cost of a mortgage up 100% since November of last year. That is insane increase in that. And ultimately, I think you're going to see that, and I've mentioned this, you're going to see that, in my opinion, really start to hurt housing. Now, next week, on the earnings front, we have Lennar and we have KB Homes, which are two of the bigger home builders out there. I'm curious to see not only what their numbers come out, but also what are their forecasts going forward. Because if mortgage rates have jumped from, let's say 3% to 6%, clearly, there are people who will no longer qualify at Toll Brothers, Lennar, KB Homes to get funding from them and put price on them. So there you go. Pepe says, hey Merlin, can you explain in simple words how the Fed can and cannot help the economy get on the right track? I get confused between bonds, printing, money, tapering. Well, that's a big discussion. Are you trying to get this to a 1-hour show? Pepe, that requires a nice sip of whiskey. If somebody knows that has a connections at Bibb and Tucker, see if we can get a sponsorship, because this is probably next to Blanton's, which is a little bit commercialized. Bibb and Tucker has got to be my favorite. Okay, so let's just talk about normal markets, Pepe. And you totally threw a curveball here, but that's just the way that this show works. Actually, let me go to Big Eb's. Cash covered puts, yes. So I always do cash secured. So I'm going to go down the list here since Big Eb had the question marks first. In that situation, if you look at the price of the QQQs, I basically was committing myself to buy 100 shares at $269, right? So I had to put essentially $26,900 in capital for every one contract that I was looking to buy or looking to sell. And if it got down to 269 or just below 269, I would be forced to buy that. So those are cash secured. I had the money in the account to cover that. And I had more than that. I just did two. Really it's not like it's a big trade or anything, guys. This was not a big trade, but it was just kind of fun to play. A few $100 for the week is not bad for something I felt was fairly low risk and a high return. So if it's a cash secured put, you'd have to have the money in your account. And, I could have done it at any price. I will show you guys today. There has been some more questions about selling options and how that works and can we get 2%? Yes, my goal is generally 1% per month in my main options trading account, which is probably my biggest account. I'm generally just trying to generate 1% or more per month. So, yeah, Alan, I've been doing this so long. I feel like this old withered man right now with regards to trading because, I've told you guys the joke before many times about the two bulls standing at the top of the hill. And if I go back to my trading career when I started back in the late 90s, I was the young bull that was just like, I got to do everything. I got to do this and that. And you do that, you get scattered and you're not consistent. But then now I find myself being the old bull, which is like, I'm going to walk down that hill and I'm going to have them all. You got to just pace yourself. I completely understand the value of getting base hits. And this was instilled actually early on from one of my coaches in when I played Little League. Unfortunately, I never became a major ball player, but a lot of people want to hit the home runs. It's glorious, right? You got people like Jose Canseco. He'll go down in the record books as just a crazy player that hit a lot of home runs. He's actually horrible to have on your team. Why? Because he doesn't get on base very much. He hits home runs, but he strikes out a gajillion times to hit a home run. It's so exciting. Oh, home run! I'd rather take the guy that's batting, 300, gets on base 30% of the time, steals bases, and generates runs. And I think that's my trading style is just give me a base hit, and I'm going to try to grind it out there and try to turn them into in-the-park home runs. Now, this one obviously is not going to be in-the-park home runs. This was just going for a little base hit, right? I had some capital. I didn't want to commit it to a big long or short position, so I decided to sell those puts. So there you go. Yeah, be Tony Gwynn, be Derek Jeter, be these guys that are hitting 300 and going straight to the Hall of Fame. Absolutely. Tony Gwynn's amazing. One of my personal favorites from the San Diego Padres and just an all-around good guy. All right, so that was Big F's question. Did J. Powell bail you out? I don't know if J. Powell bailed me out. I think the market is looking at a situation where it's sold off dramatically. I expected, we talked about this yesterday. When you had this price action right here, oh, great, these post-market ones are going to be blocking me. I actually anticipated this bounce moving up a little bit higher. I thought we'd bounce up a little bit more. That's one of the primary reasons I sold the puts is it was anticipating a bounce over the next couple days. Now, some of you might say, well, why didn't you just go long QQQ and get a better rate of return? Well, at the time, I just wasn't feeling it. I don't know. I'd rather take a little bit less risk. And, if the market would have had to drop another 4% from where I sold those options, I was fine with that. So there you go. All right, let's see. Amen to the options. I have winning 0 day expiration, iron condors, 8 of them. Awesome. That is great, Tom. 8 of the last 9 days, like Rubber Ducky, but modified based on what Brandon Wendell does and a few others. You followed like what Larry Jacobson does as well? Because I think Larry's is a little, I like Larry's a little better on the Russell versus the S&P, but still it's the same basic strategy there. And I think it once you master something and you get it down, and I'm stoked that it's working for you, Tom, because I know you took options. I think Online Trading Academy, you took options too, and taken it a few times with other people. I'm glad that you found what works for you. You found your niche, right? So you're doing SPX. Cool. Awesome. Well, great. 8 out of 9 days is pretty awesome. That's really good. I can remember as a trader where I would actually be losing 8 out of 9 days. And that's obviously the wrong side of things to be on. The good news there is you can go back, reflect, figure out what you did wrong, and come back and make your trades even better. Let's see. Fink says, Merlin, Fink, you're in Australia, right? Good day, mate. Since you already had puts, what was your thoughts on doing synthetic covered puts since credits were good? Since I had the puts, I didn't think it was going to go down any. I thought we bottomed out. That's why I wanted to close those puts. So if we look right here, this price action in 1, 2, 3, 4 days, we went from 310 all the way down to roughly 270. And if I take a measuring object and just to put it into perspective what that did in 4 days, you're looking at a decline of 12% in 4 days. To me, that's a little bit outside of normal. To me, that's overdone if something falls that far that fast. Remember, markets move 8% per year, and here I had a 12% move in 4 days. So I didn't want to look a gift horse in the mouth. At that point, my puts had soared in value. I realized that my puts were, if I remember correctly, I think my puts are for September. I don't remember. I think there were September options. So I have June, July, August. Yeah, I had September. So I had a long time to hold those. But I just knew they fell too quickly. Generally that people are running to buy those options. So I will sell them. I'll close those out. And I just, my gut was telling me through my experience, through the demand zones, and etc., and the rate announcement, that we probably have a little bit of a bounce. That's the only reason there, Fink. There really wasn't much more logic to that. It was just, I think we're oversold. Let me close out my put position. I'll sell some puts because I don't think it's going down any further. And if it does go down further, I'm going to buy the market 4% lower. Not only 4% lower, but if you take out my premium, my actual strike price would have been roughly 266.10. So it was a pretty good trade, in my opinion. Short term, if I had more capital, because I have other positions in that account that I did that trade in, I probably would have done more than just a couple of contracts. Probably would have done 10 or so. Let's see, Tom. I bounced between SPX and Russell. I need to go back and review what Larry does. I have inputs from Corey. So, yeah. Man, you got some good people to talk to, Tom. You really do. Obviously, I think the world of Corey Lane. I also think that Larry is just great at what he does. Sean's a little bit different in the way he analyzes the data, but also that's what he does. That's his job. His job is, I'm selling options. I'm doing premium. I'm peddling for premium. So, I have a lot of respect for those that are actually doing it. Again, there are a lot of people in this industry that are not doing it. They're just reading books and talking about it. So, Corey and Sean, Larry, they're out there every day trading options. I mean, hell, it almost is annoying. I go to walk into Larry's office for a meeting and ask him a question. He's like, hold on, I got some trades on. It's like, okay, all right, good for you, Larry. But yes, got to respect people who actually trade, not those that say they traded and don't trade. But we won't throw names under the bus today or throw shade at anybody that I continually throw shade at. Just give me some more whiskey. Okay, let's go back to listener questions. Not much news are coming up, so they might be a little pop, but July could be ugly. You know what? This week is one of those weeks that you dream about because of the volatility and all the crazy announcements. In my mind, it's actually been very telegraphed to see this week. The only thing that threw me off is I actually expected a little bit more of a bounce. It's really, really what I expected. Unfortunately, it didn't happen. It's okay. Everything that I was in worked out, so it's fine. Next week is a very quiet week for the U.S., so it'll probably be a much more mellow week. I'm not exactly sure which way it's going to go. We'll talk about that on Tuesday's show as I get some trades going on, but sorry, I never know who he talks about. Steve, it's one of those things that most people know who I'm talking about. Yeah. It's funny because there's an individual that works in this industry, and from what I've read and heard about him, he has more lawsuits than anybody against him. But if anybody says anything bad about this individual, he litigates. He actually will throw lawsuits. The individual that I'm talking about used to work for this guy. So you've got a guy who historically is an absolutely shady, shyster, crook, slime ball. But one of the biggest slimy guys you'll ever meet in your life. As soon as you see him, you go, oh my God, really? What kind of oil are you selling me, man? You are awful. He's one of the smoothest presenters I have ever seen in my life. I actually admired him when I first met him until I really knew who he was. And one of his employees is the person that I hate with all my heart. I think he's one of the... Thank you, Steve. It's funny that a scumbag worked for a scumbag. It's just like, wow, it's amazing how this whole chain of things work. Anyway, we'll be positive today. Think positive. Happy thoughts, happy trees. My inner Bob Ross is going on right now. Happy trees, happy trees. Okay, let me go into some listener questions here, and then we'll go into whatever the heck you guys want to talk about, because I'm having fun today. We have 35 minutes left to do whatever the heck we want to do. All right, let's go to... I didn't get a chance to look at this one at all. I didn't look at this one at all, but let me see what I got. Jeff, who sends in questions all the time. Thank you, Jeff, for sending in those questions. I appreciate it. He says, I bought puts expiring July 15th, strike price of $380. They cost me about $1,500 for $1,500 for a contract. I know you would start by asking me, what is your plan? I was looking at a target of $330 since I see a demand zone right below from there from last October. If it didn't get to $330, I may just ride it out to expiration. What are your thoughts on this? Okay, a couple things. It's a little tricky here because I don't know when you bought these puts. Jeff, if you're telling me today's the 17th, you sent this in yesterday, I believe. If you bought puts on June 16th and you bought puts that are expiring in under 1 month, you're shooting yourself in the foot. You're absolutely shooting yourself in the foot, and I'll explain why. Let me draw a little graphic up here. Yeah, here we go. Merlin's going to start drawing on the screen. Let's go to art class. So over time, the longer time frame that you give your options to work, the better as a buyer. As a seller, I want short time frame. So let's just draw a little line here, and let's just say I've got my x-axis and I got my my y and my x. All right, so this is time, and we'll call this premium. It's not necessarily premium, but essentially it looks like this. It goes, and this is expiration, right? So if this is, let's say, I'll put a hash marks on here. So this is 1 month. We'll do these one month increments, right? Let's say these are all 1 month hash marks at the bottom. I know it's not exactly even, but that's 1, 2, 3, 4, 5, 6, 7, 8, 9 months out. If you sold an option in 9 months, you're giving the market way too much time to react. So as a seller, I'm going out here when this curve starts to drop. I need to be selling options as the premium is just falling out of it, because I want to sell it and I want the buyer to be losing that premium. It's their fault for buying it. But if you are buying options, you need time. So I won't do anything less. So I'll write it down here. Buying, sorry, I forgot the I, equals 90 days. Selling, maximum 30 days. Right? So on Monday, on Tuesday, as these markets get back into active territory, I sell monthly options in my 1% account. So what do you think I'm doing? I'm going out there and I'm going to be looking at all these markets, finding things that give me great premium, that's going to give me a fairly low risk trade and give me 1% premium for 30 days. That's the goal. I will never sell an option as a seller, whether I'm selling a call or a put, that's more than 30 days. I want it to be on that downsloping curve. I want to be selling an ice cube on a 100-degree day. I do not want to be a buyer. If I am buying options, again, I need time. So the only thing I'm concerned about this strike price here is it's less than 30 days out. I don't know when you bought it, right? You said I bought puts. So let's go. I'm assuming, my gut tells me that you are talking about the SPY, if I'm not mistaken, right? So we can go out here. Let me delete some of these lines. Actually, I'll leave some and I'll redraw price points for us. So let's see. You bought on the 15th a strike of 380. So you bought in the money. All right. So you bought in the money, and it cost you $1,500. That's why you paid so much money, is because they're in the money. What's your plan? I was looking at a demand zone target of 333. Remember, if you buy those every day, they're kind of losing value, right? You go out here to 333, which is going to be, I mean, that's definitely your demand zone from way down there, but I don't see that happening in the next. I don't see that happening in the next 30 days. It could. It's a stretch, right, to go to 333. Ultimately, yes, I believe it could get there, but I think you're kind of, again, shooting yourself in the foot by going out only 1 month. I'm okay with that trade. If it didn't get to 333, I may just ride it out to expiration. Yeah. You could certainly do that. I don't do that. I don't buy in the money. I do totally different. My strategy is very different. I don't buy in the money. I buy out of the money, and I am expecting, in many cases, I don't even expect it to get there. So let's say, for example, you thought that it was going to go to 333 was your target, right? What I would be looking at is I would actually be seeing, can I buy those puts? Or can I buy those puts? Because the puts are going to be, it's so far away that the puts will be very cheap. I've noticed, for me personally, this is just my personal gut, is if I buy an option at the money, let's say it's SPY, and it falls dramatically, right? Let's say I buy a put and it falls dramatically, and the price goes from, let's say, $15 per contract, and now all of a sudden it's like $45 per contract. Well, the spread on those get incredibly wide, and all of a sudden I find I'm getting bad fills, I get slippage as well. So I actually like buying, let's say, those 333 options on here, and maybe those are going to cost me $1. But by the time price gets close, you know, when I feel comfortable, when there's just about 30 days left is my ultimate sell point, I will close those out and lock in a profit, and the spreads are going to be much more competitive, much tighter, and that's how I would approach it. But I generally don't buy in the money options like you did here. But all in all, I mean, you should be fine. You should be fine on that specific trade. So I don't think there's anything necessarily wrong with it. It's just not the way that I trade those, Jeff. But all in all, I think you're right in their direction. You bought those 380 or bought the 380s, and your target's 333. I would just be careful. I think if you get another really exacerbated sell-off that is just really aggressive, sharp one, I'd be inclined to just take some money off the table. Then when it rallies back up, buy some more puts at a better price and give yourself more time. Let's see. Next question was from Randall. Good to see you, Randall. He's in here today, somewhere hiding in the shadows. He says, is there a video that explains your 1% gain per month trade? Can I tweak it to 2%? So here's my... If you go to TraderMerlin's YouTube page, or I say TraderMerlin like I'm third person. If you go to that guy's YouTube page, go to my YouTube page, TraderMerlin, one word. You click on videos, and once you click on that, you can click on search. I'll just do that here for you so I can walk everybody through it. But if you go to YouTube, just type in TraderMerlin. Oops. I-M-E-R. I can't even spell my own name today. Great whiskey. Once you get to this little picture here, you click that TraderMerlin piece, and then this is the page, which I should probably work on making it look a little more professional. But there's a little magnifying glass off the side. If you click on that, you can type in 1%, I think. Just type in the 1%, and that should bring up the video. So there it is. It's the 1% per month strategy. And that will show you the basic framework of it. Obviously, there's some pieces that aren't covered, but you'll get the broad idea of what that 1% strategy is. Now, to your question, it says, can you tweak it to 2%? Absolutely. But remember, the whole point of me choosing 1% was I don't want to be buying these shares. I want it to be fairly risk-free. So let's walk through an example of what that might look like. It's a great question, and you can be getting 2%, but you have to take on more risk. So let's just go to something that doesn't have any lines on it. All right, so here's your NASDAQ 100. My 269 is gone. So we'll zoom out here, and let's say that we look at price right now, and you go, I'll say 250. Let's do 255s, right? You guys see the 255 level. It goes all the way back to July of 2020, right? That's the level I'm looking at. So let's say I'm thinking about buying if it gets down to that 255 mark. So let me do some exact numbers here just so we can factor in the rates of return, all that stuff, right? So there's your 255 number. I am going to do this real quick, stretch that out, and I will draw a trend line to see exactly how far down is that, right? And that line is roughly 7% down. So what I'm saying to myself is I'm willing to buy this market if it falls 7% from here, and someone's going to pay me for that privilege. Now, 255 might not be your number, right? It might be something else. So I'm looking first off is where I think it may go, and I'd be a happy buyer at 255. That's my first start. I need to assess where my potential target is and what's my, how far would this market have to fall? I think we'd all agree that 7% slide for the market in the next 30 days is absolutely doable. So what I would do from there, I would go into one of my options platforms. Here's Thinkorswim. I've got triple Qs on here, and we picked the 255s. So first thing I'm going to do is I'm going out to the next month. Now, as you notice here with the options chain, I can pick out any different option chain. You can go to next Friday if you want, or there's weeklies here, etc. I'm going to go out to July 15th, which is the monthly, and let's just say we go to 255. So here is the 255 strike price right here, and that's going to pay me $4.07. So the 255 is going to actually give me a fairly decent rate of return, right? It's going to let me here do the calculations for you. Like, how do I calculate that out? Well, first off, if it's 255 and I do one contract, that's going to be $407 worth of income, right? 407. Now, if it does get down there and execute me, I have to come up with the money for 255 times 10, which is 25,500. So we'll divide 407 by 25,500. That would give me a rate of return about 1.6%. So if I sold that option at 155, I could make myself roughly 1.6% for the next 30 days. Now, could you go to 2%? Well, what would 2% be? 2% would simply be double whatever the premium is, okay? So right here, you see it says 260. 260 would give me a rate of return of $5.21. So if you wanted to go 2%, you could certainly do that. You'd have to sell the 260 strike. Now, am I comfortable with that? I don't know. 260 is up here, which would be only 5.27% away from the market. So I don't know. It's not the greatest, but if you wanted to take that risk, you could. So let's go back to what I'm going to be looking at on Monday, which is the risk side of this, right? I'm going to be looking for 1%. So 1% would be, I'll go down here. You guys see the 245s. The 245 strike price on the triple Qs would net me roughly $2.45, which is exactly 1%. Y'all with me? So where's 255 here? I'll go back to the chart. We'll put this line at 255 or 245, excuse me. All right. And now, how far away is that? That is roughly 10.8%. So I think here is, I may have forgot about your question, Pepe. I'll get there. So my thought is, in the next 30 days, are we going to see the market drop 10.8%? We could, but that's a pretty big stretch given where we've come from, but it could happen. And if it does happen, I'm going to be getting paid 1% on my capital, and I'm okay buying there. Again, if Randall wants to make 2% on that, he would have to find something much higher up, and that number, I think we just looked at it, was what, 260 or 265. Well, it's all a matter of personal preference. You can tweak it to 2%, but you're taking on a lot more risk that you would actually be executed, and that's up to you. All right? Are the options premiums pretty much the same across the brokers? Yes. Yes. They're all coming from a centralized exchange. They're not independent. The thing that's different from broker to broker is just the transaction cost, but options are pretty cheap almost everywhere you go. So Randall, I hope that helped. If you want a different example, if that's clear for everybody out there, let me know. If not, I like things very, very simple. I'm always careful selling puts into earnings. Yes. Honestly, it's not just selling puts. You need to be careful doing anything going into earnings. I mean, even great earnings, stock could get cratered. Horrible earnings, it could soar. You just never know. So I've been burned too many times on earnings, so I just shy away from it. But there you go. So Randall, I hope that helped you. If you got questions, type them in. I'm gonna have to rehydrate here with a little glass of whiskey. I did not see the wacky options pricing on Apple because I can't trade Apple, but I'm sure someone else probably saw that one. All right, Randall, no questions on that, my friend? If you got anything, throw them in there and I'll get to it. And don't worry, Pepe, I'll get to yours. I want to make sure I get through as much as I can on this one. Because these people are sending questions to YouTube channel. I promised everyone I would get to those first. So, Richard, he says, today you were looking to go short. No, I wasn't necessarily looking to go short. So I think that was a misconception there, but I'll explain that in a second, Richard. He said, and this is from yesterday. In my chart I've drawn out below, which I'll show you in a second, the SPY looks like it's hitting the bottom of the channel, the purple line that I've drawn. And I was looking to go long short term. What am I doing wrong thinking this could be a short-term bounce to the upside of the channel, yellow line? I almost bought SPY calls today, but held off until I listened to your show today, and I'm glad I did. Here's the chart you were looking at, and there's a couple things that I want to help you with. Your trend line's drawn at the top. They're drawn incorrectly. So you're drawing trend, like this first one here, you drew it from the peak, but then you drew it to this high over here. Well, if that's a trend, then this part right here negates it all. You have this outer trend line. You're drawing across these two peaks here, but you really should be anchored at this upper one here. So you really should have the trend line from here. Let's see if I can draw. I think I can draw on this one. Yeah. Unfortunately, it's going to be really messy, but your trend line should go from there, something like that. That'd be the appropriate place to draw your trend line. Remember, you want to draw them where everybody's usually drawing them, right? So the problem is, it wasn't that I'm looking to buy puts. Again, I've explained this a few times. I still feel like overall, big picture, markets are going down. If we look at the daily and the weekly, they're all screaming it right now that these markets are probably going to continue down. And we were looking at the S&P, but I'll keep it on the NASDAQ here just for fun. What I was expecting was a short-term bounce so that I could go short more. Like, who knows? Maybe we bounced all the way back up to this area right around 305 on the triple Qs. Great. I'll start shorting more because we are making lower highs, lower lows, and that's what I'm looking for. I'm looking for adding to short positions or building new ones. So it wasn't that I think your question was saying hitting the bottom, I was going to go short. You said you were looking to go short. I am looking to go short at higher prices. So my main philosophy is go with the trend. Whatever that trend is, go with it. Don't fight it. Don't try to pick the bottom. Don't try to pick the top. That usually ends up costing you. In this case, we've got a downtrend. Lower lows, lower highs. So the higher probability trade is waiting for this to bounce back up and short it. Now, I was short, and I got out just because, again, we moved too far too fast. Generally, that will cause a huge spike in premiums, which it did. I mean, I made a killing on those put options because people were panicking and trying to buy my puts. Great. There you go. Take it. Unfortunately, it didn't do what I thought it would do, which is, again, bounce back up, allow me to short some more, and then continue the next leg down. I do believe long-term we will continue down. I do think, 245 on the Qs, totally in order. Yes, absolutely. So as far as buying those calls today, if you are in an area that's a strong demand zone, which we weren't really at a strong demand zone, yes, you could buy calls, right? But you're going counter trend. The calls will probably be rather cheap because markets are selling off. On big down days, when you have a crashing market, best day to buy calls. Why? Because they're cheap. See you, Big Eb. Cheers to you, my friend. Have a great weekend. Do something fun. So, yeah, if it's a huge down day, you can collect a lot of... Wait, Big Eb, I'm going 2 hours today. Wait, you can't leave. This is a 2-hour show. I'm kidding. If it's a huge negative day, remember, best time to be buying calls is when the market's falling apart and just absolutely crashing. Best day to be buying puts is when the market is soaring and nobody is caring about puts at all. So it's doing the opposite of what they're doing. Okay, Richard, hopefully that helped you out as well. Let's see. What was this one? Okay, another good question. Don't worry, Pepe, you're there. I'm getting your question. Glenn says, I know that I'm new to trading, but I haven't seen every stock that I look at on a weekly is down or coming into a demand zone. A little cautious about them too. You have been in this game a long time. Have you seen this before? I thought that at least one sector would be doing good. I use stocks for my 401k, and the only thing I can do is buy. I'm 99% in cash since the beginning of February. Just getting antsy. I don't really feel comfortable buying shorts or buying short stocks. I guess I'll have to wait for a higher high somewhere. Glenn, first off, congratulations. Cheers to you for being out since February. Man, you should be patting yourself. You should sit around with your friends today, have a cocktail, and go, I did awesome. You guys are down 20%? Oh, you're down 20%? You're down 15%? You know how much I'm down? 5%. Why? Because I sidestepped this garbage. I was the matador, and I saw it coming, and ole! And I moved away from that market. Good for you, man. That's awesome. And I understand your angst, right? You're looking at this going, oh God, I want to buy back in. This could rally huge. And it could. However, I'll just roughly create the number. So you said you're out since February. You don't give a specific date, but you said you're out since February. Okay. So let's go to February. And in February, I mean, you definitely took some losses, but you sidestepped a 20% drop in the market. So bravo. Congratulations. You know what you can do, and you got a 401k. If it's work provided, the first thing I would say is talk to your HR department and see if they do offer a self-directed choice. A lot of them do, but they don't want to tell their employees. So you can ask them, is it self-directed? Because if it's self-directed, what I would encourage anybody to do, and again, I guess I'm not allowed to make any financial advice, but here's what I would say. If I was in the situation, what I would absolutely do in a market like this is I would not go out there and start buying. I just wouldn't. The trend is down, right? And I understand 401k is long-term. I sure as hell would not be shorting in a 401k. Don't do that. Stick to going long because that's the That's how these are built. They're designed to be dollar cost averaging vehicles that over time make you money. So do not short. You'll erase the whole principle of a 401k. But what you could be doing is you could do exactly what we just talked about. Let's say you wanted to buy. Well, instead of buying, a technology mutual fund in your 401k, sell the 244 puts. Collect 1%. If it gets there, great. You're going to own it, but you're going to own it 10% lower than the current market. Or, let's say you wanted energy, right? XLE. Great. Well, energy's had a hell of a... you talk about the value, the premium for puts. The premium for puts on XLE today, soaring. But let's say you looked at this price chart and you go, okay, energy, I think energy is going to be great long term. Maybe I want to buy if it gets down here to 62. Well, then go out there in your 401k and see if it's self-directed. Sell the 62 puts. If it doesn't get there, who cares? You make money. If it does get there, you're buying it at a huge discount to current market, and you get to collect your premium. So option selling for me in a retirement account is a very powerful tool to help you generate your yield and increase it. Now, let's assume that you cannot. There's under no circumstances where Glenn can actually self-direct. He's got to stick with the ultimate scam, which is your 401k, where you have to buy their mutual funds and only the ones they give you. Am I bitter? Yeah, it's a scam. Anyway, so what would you do? Well, I would be looking at the different markets and saying, where would I be interested in buying? So let's say you're looking at whatever, your Fidelity Large Cap Growth Fund. Yeah, okay, well, that's going to be the SPY. So, you look out here and you go, well, where would I be interested in accumulating some SPY? And what I would say, Glenn, is don't buy all in. Maybe you stagger some. And you say, okay, if it gets down to, well, we're pretty much there anyway, 358. And I'm just kind of going off these little areas of demand. Maybe you start to outline little areas where you say, I'll buy back in 10% or 20% or 50% back in. The good news is, you're saving money by buying back at cheaper prices where anybody else who's holding their 401k is just losing money. And I get that you want to be in there earning money. Again, don't short. I think that's a fool's errand in a 401k. You defeat the purpose, in my opinion, in your rates of return could be significantly impacted. So if you're in it for the long haul, Glenn, then just pick levels and say, okay, I'll buy some if it gets down here, some if it gets down here, and just build out that way. And if it keeps on drifting lower and lower, you're going to take some losses. If let's say, for example, you said, I'm going to buy the SPY if it gets to 333, right? That's this top red line. Let's just take this one out here, take this 380 out. All right, the red line that you see horizontal on your screen, that's the 332. So let's say you sold the you told yourself, I'm going to buy my large cap Fidelity mutual fund that's in my 401k plan if it gets down to 332. Great. And if it falls and keeps on going, gets to 330, you're going to be losing some money. But you're not going to be losing anywhere near as much as that individual who is holding the whole way, right? No, you can't shorten a 401k. If it's self-directed, you technically can. You can't actually short, but you can buy things that are inverse and are short if it's self-directed. But I personally don't think that you should be doing that in a 401k. Do that in a trading account. 401k, reserve it for long-term growth and buying. Am I right? Yes, correct. You cannot shorten a 401k. You're starting to see the creation of some instruments that might be inverse, but most fund managers don't allow you to go. Most mutual funds will not include that in a 401k plan. They always are long-term buy investments, not shorting. So you're correct, Mimi. Merlin OTA recommended buy options in the money or at the money and sell out of the money. You have different strategy. What is the benefits of buying out of the money options? It's just a personal preference. I think what OTA teaches is a great methodology. It doesn't fit my personality style. I don't like paying at the money or in the money. The premiums are much higher, and then if it does move in my direction, it's really expensive. It's just my mindset, right? I'm frugal, so I see a big number. I don't want to do that. I'd rather look and see. And again, mine is much more of a speculative strategy. But if I'm finding something that's in a trend and making the assumption that's going to go to a specific value, I will already anticipate, okay, 30 days, 60 days, 90 days, whatever I'm thinking of buying or selling. Let's say I'm buying 90 days out. I'm going to buy at the strike price I think it's going to get to because the premiums are going to be really cheap. That's the only reason why. What are the odds for SPY to go lower than the COVID lows? Hell, I'm not a bookie. I'm not a bookie, Joe. Are the odds... let's first off just ask yourself, can it do it, right? A lot of people are saying there's no way. I believe that there is absolutely a pretty decent chance. You know, are we talking 50% chance? Yeah, sure. I'll say 50% chance. But I mean, look how much it would have to drop, right? If we go to current levels, which are right there, to the lows of 2020, that's a 40% decline from current value. And if you go from where we were at the peak, I mean, you're talking a 54% decline in markets. And I think a lot of people look at that and go, oh, that's not going to happen. There's no way we're going to drop 54%. And of course, you all know what I'm going to do. I'm just going to show you monthly and show you these two right here, right? From 2000 to 2003, 50% decline. 2007 to 2009, 57% decline. So it has happened, and it can easily happen again. Personally, I think it's long overdue. I really think it's long overdue for us to have a zeroing out of all of this toxic money printing fiasco that we've had. I don't know if you guys saw the tweet that I posted today. Did you guys see the tweet that I posted today? I had fun with that one. It was actually sent for me by one of my coworkers, so shout out Tim, but let's see if I can bring it up for you, just because I thought it was humorous. I normally don't like bring up my Twitter page here, but let's just check it out. I want to show you the picture here. Check out this picture. It's great. On the top, you've got a trolley, and the trolley has, two tracks, and then you see the switch guy here who's going to switch the tracks. And on one track, you have high inflation with one person getting killed, and then straight ahead would be like 5 people in the tracks all tied to them, and that's the recession. And then you see the Fed has taken and wired those tracks so it loops back together. And I wrote, thank you, Federal Reserve. This was not caused by the Democrats. It's not caused by the Republicans. Hell, this isn't caused by libertarians, Greenpeace, Green Party, whatever. It's caused by the Fed. I go, time to end the Fed. I thought this was kind of a funny one. Sorry to gratuitously promote my Twitter channel, which I hardly ever use, but I think it does speak volumes. And again, I went on a little bit of a rant yesterday. I apologize because I don't like to go political here. I think politics have no... show Daniel's comment. Your comments are always great. You have fun with those. Let's see, where did all the comments go? I'm not a fan of going political. I think it's just a waste of your time and your energy. However, a lot of people are pointing the finger at specific political parties, and I don't know. I think it's just... I think the truth is it's money printing. Anyway, here's Daniel's comment. He says, I found TraderMerlin and Minecraft animation money. You're responsible for all of this. Yes, I feel like got a little bit of a rant. There you go. All right, let me go to Glenn's question. All right, last one. How much time we got? Big Eb's gone. Oh, gosh, I got 7 minutes. All right, I'll make this quick. This is a great question from Glenn again. So Glenn, glad you sent this one in. Thank you. He says, in the futures market, the ZF, the ZM, the ZB are supposed to be bonds. I don't understand how it really worked. The Fed was buying bonds for over a decade, maybe 2 decades. And the bonds were going down since the year 2000. And now they're selling bonds since March 2022. March 2022 is the only up month. So my question is, what is and or what really drives ZF, ZN, ZB? Is it the interest rate? If that is so, wouldn't it be heading up with rate hikes? Okay. What's important to remember is there's an inverse relationship between bonds and with the yield. If we look here is your ZN, right? I could look at the ZN, ZB, ZF, but we'll just take the 10-year, right? Notice what's been happening. The 10-year has, this is a monthly. Let me go back to, I think a daily would be better. Notice what's been happening on the daily. It has been just absolutely selling off. And you're like, wait a minute, if yields are rising, why is that? Because you have to look at it this way. If you bought $1,000 par value bond, right? So let's say you buy a bond, it's worth $1,000, and the yield on that is, let's say, 1.5%. Okay, so at this point, you're going to be receiving 1.5% per year, and at the time of expiration, you'll get your $1,000. Great. But all of a sudden, we've gone from 1.5 to 3%. The new bonds issued right now are over 3% for the same bond. So what do you think is going to happen? Do you think that same bond is going to sell for $1,000? No. That bond that was making 1.5% is going to decline significantly in value. So it's no longer going to be $1,000. It might not even be $900. It could be $800 or $700 or $600. Why? Because the new bonds are paying such a big premium, you have to discount your bond to sell it. That's why they're inverse. So if you notice here, this is the actual value of the bonds. So the futures that you reference, ZN, ZF, and ZB, are the value of the bonds. And then the things like the US 10-year, that's your yield. And notice a direct inverse correlation. So as yields continue, or not continue, but as yields move higher, what's going to happen to the price of bonds? The new 10 years are going to have to rebalance themselves. So anybody who bought a 10-year bond a year ago, they're going to have to, if they want to sell it, they're going to have to sell it for less dollars. They will not get their $1,000 par value. They may actually get, again, $800 or $700, depends, based off what the yield does. So as this yield keeps rising, you're going to continue to see bond prices like this declining. So here's your 10-year, and here's your T-bond. Remember, yields are surging. The price of those bonds drop. That's why there's that inverse relationship. So if we continue to get rate hikes, you are going to see all of those bond products you mentioned, Glenn, the ZF, the ZN, and the ZB, those will continue to go down in value. And if you look at things like TLT, right? TLT is an ETF. Same picture. This is based off the price of bonds, not interest rates. So again, if yields keep rising, TLT is going to keep dying. And we talked about this a year ago going, rates are going to keep rising here. TLT is going to be a fairly decent short. And notice how much that thing has declined. It has been just a really ugly sell-off here in TLT. The trend was there, and it is now gone. All right, last piece is going to be Pepe's question here, which I'll wrap up because and we're going to go over an hour just for that's just because Big Eb took off today. Could be the whiskey too. Let's see. I'm scrolling back to the top here to try to find Pepe. Okay, so Pepe says, Merlin, can you explain in simple words how the Fed can and cannot help the economy get back on the right track? I get confused between bonds, printing, money, tapering, etc. All right. It's really, you almost have to build a flow chart here. So I'm going to make a visual for myself. And let's say that we have a situation where the markets are selling off, right? And that's where we're at right now. You're seeing things get really weak. Markets are collapsing. Now, in theory, the Fed should have nothing to do with the markets, right? They should be completely independent. But I think we all understand that the markets are an indication as how the economy is performing, right? So if we have a market that's selling off, as we do right now, we know that there is going to be a direct correlation to that. As the economy slows, we can see that reflected in things like GDP. We can see that reflected in retail sales numbers, durable goods orders. So we have those three basic pieces of economic data, and there's many more, but those three pieces gives us clues as to what the economy is doing. Now, let's say on high-level surface value, you have the markets are tanking. You have GDP is slowing down. Retail sales numbers are declining, and you have the third member, I can't remember what I was just talking about, but you have those durable goods orders are declining as well, which means consumption is declining. So the Fed now looks at this and goes, okay, we need to help stimulate growth because those declines in GDP, retail sales, and durable goods orders, that's going to lead to layoffs. So we need to stimulate. Let's print money. And how do they do? Well, basically what they'll do is they start buying bonds. And they buy bonds because if they continue to buy all of these bonds, the yields will decline. And what they want to do is get yields very low. They'll also drop the Fed funds rate lower to make borrowing for banks easy so that banks can now lend out, and that helps stimulate growth, which increases jobs, it increases production, and that's their mechanism. However, because they've been doing that with reckless abandon for the past 13 years, right? That's all they've been doing. They've been buying bonds, trillions of dollars worth of bonds to help the economy. They have been doing everything that they can to stimulate the economy. However, at a certain point, all that capital infusion, the money pouring into the markets, creates inflation. So in a normal situation with normal inflation that's not rising, that's what the Fed would do. The Fed would cut rates, they'd start buying bonds, lower the yield curve so money is cheap, everybody wins. However, can they do that right now? The answer is no, they can't. They can't start printing money again because increased money supply is why we have inflation at 10%. So any attempt to do those three things I just mentioned, they cannot do that now. They've literally been boxed in a corner because if they do decide to drop the yield, what does that do? That stimulates the economy, and all of a sudden we get a huge surge again in inflation. Inflation is choking people out. I mean, we had a company-wide meeting, and a lot of people were like, well, I don't want to drive to the office because gas prices have doubled and it costs me more money. It's like, okay, well, then walk to work, all right? But anyway, I'm that bitter Elon Musk supporter who says everybody should be at the office anyway. But the point is, Many of you are probably feeling that pinch. Hell, I went to cook dinner the other night because I don't want to eat out. I made this really nice crock pot dinner, $28 for all the ingredients. 2 years ago, that would have cost me $10 for the same ingredients. So their goal right now isn't fighting, helping the economy get on track. They have to fight inflation. So now all of a sudden, all the actions they could have done, Pepe, are gone. They cannot print more money. They can't cut rates. They have to raise rates to fight inflation. It's like, what's the bigger evil? A market crash or super high inflation? Well, if you don't fight inflation, you're going to have a market crash anyway. So fight inflation, have a market crash, and see what happens. But, my feeling is we're going to see markets crash because of the inflation side of things. So they're trapped. They're really trapped with what they can do. Jamie, I am. I'm really a fan of free markets. And I'm not 100% against the Fed. I do think that the Fed should be a mechanism to help the economy grow, not completely manipulate it, right? For example, you go to a doctor with, let's say you have back surgery. You have back surgery. And the back surgery, they give you shots of morphine so that you don't feel any pain during the surgery. And when you come out, they wean you off of it rather quickly so you're not addicted to morphine. What the Fed has done, effectively, has said, okay, we know that back surgery should last maybe 6 months. Well, here we are 13 years later, and we're still loading you up with morphine. And not only that, but we have increased exponentially the amount of drugs in your system. How do you think that human being's going to function? They're going to be a vegetable. They will not be a normal human being. Our economy, our markets are not normal. So, it is what it is. I'm not an economist. I'm not a central banker, but I'm a realist who just sits back and looks at the data and what I've learned through Keynesian economics and Austrian economics and says, shit, we got a problem here. And, bottom line is, hopefully you guys make money off it. And I know it sounds anti-patriotic to think short the markets or be selling puts right now and buying things lower. It's opportunity, guys. If this market drops another 40% and we get back to the lows of 2020, it's opportunity. Don't let anybody tell you you're being anti-patriotic or you're taking advantage of America. No, it's a profession. You are trading the markets that were overpriced, overvalued, overinflated. Simple as that. Pepe, thank you very much, my friend. I appreciate that. Let's see. What did Daniel say? Legalize weed. That would raise consumption. We don't need more consumption. You need something that's an appetite suppressant. Isn't that cigarettes? Everyone should go smoke cigarettes so we don't have we all start losing weight and not eating anymore. Is it possible for governments to set price controls? For example, gas prices are too high. I'm not a big historian, Rob, but I think that in the past that has been tried in different countries around the world, and setting price controls for things, from what I've read, generally ends miserably, ends really badly. So, in that sense, we kind of have a free market. As John O'Donnell says all the time, and I really do see this happening now, the cure for a high price is a high price. So, I've been encouraging people. I know it sounds kind of bad, but stop spending money, people. For the next year, let's say 365 days, challenge yourself to go, you know what, we're going to go do that and spend a ton of money. I'm going to do something maybe very different that costs half the money or a quarter of the money, or maybe just stay at home and not do that activity. Because I think that money is going to be in a crunch for a while. You're seeing credit consumption, some of the highest levels it's ever been. That is going to come home to roost and be very ugly. And I'm pretty certain, if I had to say, I would say I'm like a 95% certain we're going to be in recession. The question is, what's the probability of a depression, right? How long will it take us to fix that high inflation factor and the slow growth factor? And ultimately, it's going to be high unemployment. We'll see. My guess is by August, September, October, you'll see that unemployment number start to curve back up. And then everyone's going to start to talk again. I'm like, uh-oh, here we go. Does that lead to a depression? I don't know. Hopefully, I will be short during that process, and you guys will see my actions here on the show as far as what I can do. So congratulations, Big Eb. Cheers to Big Eb. This is a 1-hour show today. I hope you all have a fantastic remainder of your weekend. There's no real economic announcements for Monday. We will be back on Tuesday for another fun show. Again, Pepe, thank you for the contribution. Cheers, everybody. Do something fun. Be nice to your fellow human being, and I will see you all on... Oh, yeah. If you have comments, questions, feedback, put them down below the YouTube channel or email me, TraderMerlin@gmail.com. Cheers, everyone. Have a great weekend. I'll see you next week.